Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, and see what people are sharing. If you want to join me on here, it's at Finding_Finance. And if you want to join the community on the website, finding-value.com, I dive deeper into all this stuff looking for investment opportunities. We do have a discount code. Discount is that code, discount. And you get a discount if you can sign up. And I'm releasing a midweek update, which you can view on the website today. So, Eric Nuttall, it says U.S. energy independence is a fantasy, and Canada is a critical component of U.S. energy security, especially with the twilight of shale. And he's saying shale rolling over. To tariff a reliable and cheap source of irreplaceable crude oil is lunacy. If tariffs do come into place, we think they will be short lived. And I completely agree with them. I don't know why anyone would tax your energy base. That's as most inflation as you can get. They do that in California with gasoline tax. It's very high in California on gasoline. In other states, they barely put any tax on it. Colorado being one of them. Our gasoline is one of the cheapest out there amongst the states. California is one of the most expensive, and it's due to the tax that's put on it. But here's U.S. shale oil production growth that's projected forward. In 2025, they estimate a slight increase in production, about 340,000 barrels. I'm not sure if they'll get that or not, but that's the projection. And then they project out in the future for 26, 27, and 28 to basically be flat and then decline from 2029 and 2030 onward. That's when the declines start to happen. But if you look at the go forward demand growth rate, which is this line way above here, we need to grow above that line if we're going to keep up with the demand growth. So what this is projecting is that since we're below the demand growth, that we will have a potential deficit, or we need to get oil from somewhere else within the world. If we don't get that oil from somewhere else in the world, and oil shale's been about 95% of our growth in oil production around the world, we are going to rely on that other 5% growth areas. If they don't grow, oil prices will go up because we'll be running deficits and we'll eat through our spare capacity and also eat through our inventories. If we eat through our inventories, we'll probably hit a price per barrel number where OPEC starts to increase supply from some of the supply that they have brought offline. As we go through these couple of years, the entire spare capacity will be eaten through if we don't bring on more new oil. We will then be at the pumping capacity of the entire world, which we have never been at. We've never been where we've had zero spare capacity and been at the pumping capacity of the world. That will probably happen within a few years here. And if we get decline rates like we've got projected in 29 and 2030, and remember, this is assuming that this is right, we could see declines quicker where it puts pressure on the overall supply capacity quicker. So this is like, we've never been in this situation. We've been in this situation briefly in 1970s for America only. We've been in the situation briefly in the 2000s for world conventional production. And now we could be, and I don't know for sure, but we could be topping for unconventional and conventional together. And if we start to decline, that is where things get dicey because I just don't know. We've never been in that situation. It's going to make $150 a barrel look like that's cheap as all get out if that were to occur. You could maybe even add a zero to the end of it, if the decline rate is strong. We don't know what the decline rate looks like. We don't know if it's going to be flat. We don't know what the top looks like. We don't know if technology is going to accelerate it. We've got a lot of unconventional stuff that we've brought on with really strong decline rates. So we don't know what this peak will look like necessarily. But yeah. Here's Sam Gatling. He says copper and gold dance together. And gold's been working to the all-time high, and you can see the fractal movements are the same here. And basically, copper, I think, is going to follow where gold goes. Gold is an accounting mechanism of money being created before, like it's a real-time accounter. Copper and oil and all these other ones, they lag gold because it's not a real-time accounting mechanism. There's a lag between money being created and money flowing through the system. Copper and oil they respond with the money flowing through the system. Gold front runs it. So gold moving on up is front running most likely the moves in copper and oil that we're getting today. This is above ground crude inventories. They keep drawing. They're all the way down here for 2025, well below everything else in history going back to 2017. Now, going back to 2017 and a lot of those areas, we had times during that time frame where oil was $120 a barrel or more. So why are we so low with the inventory so low? I think it deals with the spare capacity that people think we have in OPEC. So I think what they think is that, it's fine. We've got spare capacity. These next few years are going to take those assurances out of the market. So it's coming, and we don't have a lot of inventory in strategic petroleum reserves and onshore and commercial inventories. They've drawn down. So this is the first step. The first step is to draw down inventories. The second step is to eat through supply, the supply capacity. And then we're at pumping capacity, the world that we've never been at. When we ran in the 2000s, we had a spare capacity of about 2 million barrels. We've got a spare capacity of about 4 million barrels right now, somewhere in that range. Some people say it's 6. I don't think it's 6. I think we can have a spare capacity of about 4 that we could hold. We may have pumping capacity of 5 if we were to have a short-term jolt. I don't know how sustaining it is, though. So I would say a sustaining 4 million barrels. When we eat through about 2 million of it, which could take about a year, then I don't know we're going to get all sorts of dicey in terms of pumping capacity and spare capacity and inventories. Brian decoded here, and this guy, let's just read this. I don't know, but let's talk about it together. It's 2034, your 9-to-5 job is extinct. Everything is so cheap, you don't anymore. That's Reid Hoffman's latest prediction, the founder of LinkedIn, who predicted the rise of social media in 1997. So this is in stark contrast to what I'm seeing in oil and potentially in a lot of these different commodities that could be peaking in production, the flow rates of the commodities in the 2020s and 2030s. So this is in stark contrast at 2034. Let's see what he has to say. Hoffman's work is legendary. Reid Hoffman co-founded LinkedIn, and pioneering platform for professional networking, which has transformed how people build business relationships worldwide. And since then, he predicted all the trends that shape our world today. Predicted that social networks would change the world. LinkedIn sold for $26 billion, saw the sharing economy coming, early Airbnb investor, called the AI revolution years before ChatGPT. He's a man who writes the future, and this is an alarming prediction. Hoffman predicts that AI will make many things 1,000 times cheaper. Legal briefs, medical diagnosis, management consulting will cost pennies compared to thousands of dollars now. I actually do agree with that. If everything's cheaper, I don't think. You can spend the money you save on all other parts of your life. And if things that cost thousands before are cheap, the amount you need to work could fall drastically. Let's take any context where we rely on another human. You can train an AI to be whoever you need it to be by inputting just a few bits of information. Reid Hoffman thinks that AI will make assistants, teachers, and coaches available to everyone. But with all the technology, there's an even bigger variety. A large number of people will be a business. With tools like DALL-E, ChatGPT, and Cloud, anything collapse. A few quick prompts will generate entire articles, sketches, and websites. What does this mean for you? The focus shifts to the idea rather than execution. Wealth will accrue to those with the best ideas rather than those who work the hardest. And it's your once in a lifetime opportunity to create a business you've always wanted to, Reid Hoffman notes. AI augmented entrepreneurs, programmers, and filmmakers gain the ability to realize their visions far faster and at greater scale than ever before. The AI economy is just starting. And if you're reading this, you're early. That's why you need to take action today. Reid Hoffman thinks we're still crazy early to the internet. Anybody on the planet can create a business online. All you need to create connections, opportunities, and wealth are your thoughts and your laptop. You're missing out if you're not. That's where the website comes in. So to recap, AI will transform work and costs. Everything will be cheap, reducing the need to work. AI will make services like legal and medical. Focus will shift to ideas, not hard work, and anyone can start a business with AI tools. So that's kind of what this is. I do agree with some of it. Now, where I find a little bit difficult to digest is they're going to find solutions, I think, to physical things in this world. But I do think that we're going to run into some constraints with perhaps some elements on the periodic table. So I think copper is going to get real tight. I think energy could get tight. And then I don't know how AI is going to overcome that. But maybe AI knows things that humans can't conceive of today. So I am open to that, where it could figure out problems today that I just can't even conceive of. Aisha Tarek says, a good chart from Goldman Sachs that shows how sectors and factors may react to change in the 10-year bond yields. So this is sector sensitivity to bond yields. I actually go over this quite a bit, and this is what I use for cycle market conditions that are changing based off cycles. So what I think is coming is an increase in interest rates for a while. And the sectors that perform well with increasing interest rates are the ones at the top here. Cyclicals, financials, value, energy, small caps, chemicals, auto parts, and industrials. You can also chart these against the ones that are going down. You can do a ratio of cyclicals versus, say, technology, and whatever's outperforming can tell you a little bit about the market condition. If you chart all of these and they're all outperforming these, that means that you're in a specific market condition where yields are going up, and that will probably continue. We can also see if these start to bottom against these, that the cycle is probably turning. The ones that are the worst performers on this by Goldman Sachs: real estate, defensives, consumer production services, utilities, telecom, healthcare, consumer staples, retailers, growth, travel and leisure, and technology. Coming down to Porter Stansberry, let's read this guy here. So term premium, this is interest rates. So that's term premium means interest rates on government bonds is going way, way higher because there is no realistic plan to balance the budget in the United States and increases to the debt are spiraling out of control. Default is going to become a real risk or a vastly higher inflation. So this, what he's talking about is interest rates going on up. Says there's not a single media outlet that has been honest about the numbers. So let's go through the numbers together that he has. The government collects $2.5 trillion in income tax, $1.6 trillion in payroll, and $550 billion in corporate taxes, all of which are passed along to consumers. The other stuff, tariffs, estate taxes, etc., they're all rounding errors. In total, that's $5 trillion in revenue. Meanwhile, the Fed is spending $7 trillion every year. And most of all of this spending, the $4 trillion, is interest, Social Security, and Medicare, Medicaid. Line items that are all growing much faster than economic growth. There's no viable plan to stop the big increases to these budget items. Even if Elon succeeds in cutting $2 trillion in spending, which will be impossible, at most he'll cut $500 billion or so. We will still be running bigger and bigger deficits every year. And here's the part no one will explain to you or say out loud. Number one, your fellow citizens are incentivized through progressive taxation to always vote for more government spending. That's why there is no democratic way to balance the budget, to begin to repay the debt, or bring inflation under control. Any politician that promises to do so will lose every election. Number two, without large reductions to entitlement spending, inflation will continue to increase, as printing money is the only way to afford these commitments. Raising taxes won't work because the highest marginal rates are already leading people to stop working and to take extreme steps to avoid taxes, like moving to Puerto Rico, etc. For real info about the limits to eating the rich, see this article below. Number three, increasing inflation will make it impossible for young people, 18 to 34, to afford anything like a normal life. They will become progressively more alienated, more radicalized, and eventually more politically violent. America has become a socialist state, and socialist states fail. When they fail, there's violence. Be prepared, in his opinion, about increasing interest rates and the government's inability to do anything about it, and to cut that spending out of it. Investment wisdom: a market downturn doesn't bother us. For us and our long-term investors, it is an opportunity to increase our ownership of great companies with great management at good prices, says Warren Buffett. He loves the pullbacks. Grady here, he says, we're really extremely fortunate to be here, seeing this glorious commodities bull market develop and having the stamina plus tools to make the most of it. Do not miss or mess up what will be the greatest bull ever seen. And he's got commodities versus the US stock market, which is the Dow Jones Industrial Average, and we're doing this big double bottom here. He says, in his opinion, nothing but commodities bubble. A 36x of that comparison between commodities versus the US stock market. So the stock market could come down and commodities could go up to create that 36x. He says when this ratio moves up, commodities outperform the stock market. The chart has that preparing for a slingshot look, like it's about to rip. We are very close. It's coming. Nassim Taleb says, remember that nobody accepts randomness in his own success, only his failure. Money wisdom: if you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks, says John Bogle. The big picture charts I post, this is another one from Grady, shows the life-changing opportunity this commodity bull really has. Below shows Palladium starting its bull market. Many will now wake up to platinum and palladium, but go with us. I have played these sectors for decades. Yep, 40-year parabolic base indicating a huge move coming. We've got this support going across that we basically come to and are tagging. He's got this parabolic move. He says another 2,111% move up, this time starting at 1170, would mean the target is $24,700. That's what is incoming potentially for palladium. Now, the ratio, platinum generally trades more expensive to palladium. And if we get platinum that is 2 or 3 or 4 times that cost, we could even go way above that for platinum. So, having a mixed bag of all these things, I think, is probably a good idea instead of just playing one. And this is all rooted in bad debt, that inflation coming from bad debt, that up here that we went over, the problem that we're in, the predicament that we're in, that Porter Stansberry talks about, the interest rates going way up, and the problem that we have with that the government's going to face here. That's what's driving these rotations of money in the markets, and for palladium to do this ridiculous move. It's rooted in the debt problem that we've got in the United States. That's the driver. It's not palladium itself. It's not commodities itself. It's the dollar that's about to eat SHIT, super high intensity training. So Grady, here is the dollar here. This is a big one that could start this big move. He says, I managed to nail the 2 previous tops in the US dollar. So, of course, I have to try and do it this time around. So here it goes. He's now calling the USD top right here. The euro looks ready here now for putting in the weekly cycle low, and that means that the US dollar should be ready to top for the weekly cycle high. The euro should push USD down as it moves up. This major currency cycle's turn should mean that we will get one of my everything but USD and yields up moves, i.e., the United States dollar dropping should push up almost everything for a while. So he's calling the top right here since EUR looks ready to reverse back up, which should push the United States dollar down from here. Here it is. We'll see if that's right, and that's going to be a huge tailwind behind gold, palladium, platinum, all of these things. And they're all squeezed up in those charts. We've been watching it. So maybe this could be the potential move lower here that really blows us to the upside. Joel Greenblatt says, unless you buy a stock at the exact bottom, which is next to impossible, you will be down at some point after you make every single investment. Your success entirely depends on how dispassionate you are toward short-term stock price fluctuations. Behavior matters, says Joel Greenblatt. And I experienced that too. No one catches the exact bottom, and generally in the beginning you're down on your stocks, and almost all of them. I totally agree. So Ian Castle says, the older you get, the more comfortable you become with who you are, and the less you care about convincing others they should invest like you. You start to understand the real edge is in the areas you are unique, different, and it's a blessing others can't see what you see right now. No need to waste energy proving you are right today when time and business execution will do it for you. Totally agree with that. And of course, that kicked me out that way. So we've got at least 65 tankers drop anchor in Asia, Russia, Middle East after being hit with U.S. sanctions on January 10th, ship tracking data. So at least 65 tankers to drop anchor in Asia, Russia, Middle East. The average age when people buy their first stock is 33. Were you younger or older when you bought your first stock? I think I bought my first stock when I first started working after college. So I think it was 22 or 23 years old, somewhere in there. Probably 22. The Brazilian real is going downhill, and it's probably going to be a bottom if he's saying that. I do see a shoulder, head, and a shoulder, and a potential breakout. So that looks like a bottoming pattern to me. That's what I'd say. The energy realist. The offshore soft patch, evident in subsea tree awards as 24 will finish below 23. Here, let's just go straight. I don't even know what he's talking about there, but subsea tree awards down. So subsea tree. Let's go here. Offshore project FIDS forecast. Pretty small, and then we've got an uptick here. The offshore project FIDS forecast. I don't know what I'm talking about here. We'll skip by this. Skip by this. I don't know why I shared that one. Global silver production continues to grind lower while world gold production forecasted to hit a new high in 2024. So global silver production is down 80 million ounces from its peak in 2016, while world gold production is up 6 million ounces. Look at the trend here. We peaked in 2016. 2008 is where platinum group metals peaked. Well, I should say platinum itself peaked. I don't know if all the group metals peaked at that time, but we've already hit peak production in some of these metals, and they've been tracking and trending lower. And I don't know if that's because of the price or if it's because of geology. Tough to say. Cuppy was down last year. His net return was minus 10.55% for 2024, and he had a rough year. It looks like I was pretty much. I think I ended up slightly up. I didn't add all of it together, but a lot of offshore. He's in a lot of offshore stuff. I got hit with my offshore stuff somewhat bad. There were some companies that were up. Obviously, I ended up the year barely. So I was kind of treading water on some stuff. I was up on some and I was down on some. So I kind of all averaged out pretty close to a flat year for myself. At what age, realistically, should you have $100,000 invested? I don't know what age you should realistically have, but you try to get it as fast as possible. I think I hit 100 grand probably after 3 years of working in total. That's 401k and everything else that I saved. I just saved everything I could. So I probably did it by 25 or 26 years old. That would be my guess. They're saying the quiet part out loud. Domestic critical mineral supply is a national security issue. We spent decades underinvesting in outsourcing production, processing, and development of these metals to China, Russia, and others. It's all unwinding. So this is an article, Securing Critical Minerals Vital to National Security, official says, and there's a bunch of critical minerals that are vital to our security. There's a whole bunch. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We've got that Platinum midweek update that's being released. You can check that out. It's released on the website. And that's all I've got for today, guys. So we'll catch you later. This is Finding Value.